Welcome back to the COO's office. In our last session, we built a castle. We identified companies with wide economic moats, strong brands, high switching costs, and network effects. We found companies that can fight off competitors and survive for decades. You are feeling confident. You have a great business with a strong defense. You are ready to launch. But imagine you are the captain of the best ship ever built. It is unsinkable. It has the best crew. It has the best sails. But if you sail that ship directly into a Category 5 hurricane, you are going to have a very bad time. In the world of investing, the ship is your company. The weather is the macroeconomy. Even the best companies in the world cannot escape the gravity of the macroeconomy. When the weather turns bad, everything falls. When the sun shines, even the garbage floats. Today, we are going to look up at the sky. We are going to discuss macro indicators and their relationship with stocks. Specifically, we will focus on the two most powerful forces in the financial universe, interest rates and exchange rates. Let's start with the most important number in the world, interest rates. Think of interest rates as gravity. When interest rates are low, like 0% gravity is low, money is cheap. It is easy to borrow. People feel rich. In a low-gravity environment, asset prices float upwards. Stocks go up. Real estate goes up. Even risky assets like cryptocurrencies or art fly to the moon. Why? Because if the bank pays you zero interest to save your money, you are forced to invest it in risky things to get a return. This pushes stock prices up. But what happens when interest rates go up? Gravity increases? Suddenly, money becomes expensive. It costs more to borrow for a house. It costs more for companies to borrow to build factories. More importantly, the bank now pays you a safe 5% risk-free return. Investors look at the stock market and say, why should I risk my money in stocks for a potential 8% return when I can get a guaranteed 5% from the government? So, they pull their money out of stocks. They sell. When gravity increases, asset prices crash down to earth. The highest flyers, the tech stocks, the growth stocks, crash the hardest. As the coup, you must watch the central bank, the Federal Reserve. They control the gravity dial. The rule is simple. Don't fight the Fed. If the Fed is raising rates, they are trying to slow down the economy. Do not be aggressive. Be defensive. Hold cash. Buy companies with real profits, not just promises. If the Fed is lowering rates, they are trying to stimulate the economy. This is the time to be aggressive. This is when the next bull market begins. Now, let's talk about the second major force. Exchange rates currency. Specifically, we need to talk about the US dollar. The US dollar is the reserve currency of the world. It is the king. When the US dollar is strong, it acts like a giant vacuum cleaner. It sucks capital away from the rest of the world. Investors sell assets in Europe, in Asia, in emerging markets, and they move that money into US dollars to buy safe US Treasury bonds. For a global investor, a strong dollar usually means pain. It means emerging markets will struggle. It means global trade slows down because commodities like oil and gold are priced in dollars, so when the dollar goes up, oil becomes more expensive for everyone else to buy. But how does it affect the companies in your portfolio? It depends on where they make their money. Let's say you own a massive American company like Apple or Nike. They sell products all over the world. They earn euros in France and yen in Japan. If the dollar is very strong, those euros and yen are worth less when converted back into dollars. So, a strong dollar actually hurts the earnings of big US multinational exporters. Conversely, if you own a small company that imports materials from abroad and sells them inside the US, a strong dollar is great. Their buying power has just increased. So, the coup looks at the currency charts and asks, is the king dollar getting stronger or weaker? If the dollar is rising, I should be careful with emerging markets and US exporters. If the dollar is falling, global liquidity increases, and it is party time for international stocks and commodities. Now, I know what you are thinking. This is too complicated. I cannot predict interest rates. I cannot predict the currency markets. Even the experts get it wrong. You are absolutely right. The goal of You Inc. is not to predict the macroeconomy. The goal is to prepare for it. We do not own a crystal ball. We own an umbrella. Here is the COO's action plan for macro indicators. 1. Respect the cycle. Understand that the economy moves in seasons. There is a season of expansion, low rates, and a season of contraction, high rates. Do not expect summer to last forever. When winter comes, put on a coat. Defensive stocks cash. 2. Watch the yield curve. This is a technical term, but keep it simple. Usually, long-term bonds pay more interest than short-term bonds. When this flips, when short-term bonds pay more than long-term bonds, it is called an inverted yield curve. This has successfully predicted almost every recession in history. When you see this, start building your cash reserves. 3. Focus on quality. Remember the moats we discussed? When interest rates rise and the economy gets tough, weak companies die. They cannot pay their debts, but companies with strong moats and lots of cash survive. In fact, they get stronger because they can buy their dying competitors for cheap. In bad macro weather, quality is your only life jacket. So, look at the news. What is the inflation rate? What is the central bank doing? Is the dollar crushing other currencies? You don't need to be an economist. You just need to know if it is raining or sunny, so you can dress you ink in the right clothes. Now that we understand the big picture, the weather, we need to zoom back in. We need to find specific opportunities. We need to find the specific industries that will thrive in the current environment. But where do we get this information? Do we just Google it? Do we watch TV? No. The pros read industry reports. In the next episode, we are going to learn how to read the professional maps used by Wall Street. We will discuss know-how on analyzing industry reports. We will learn how to extract gold from those 50-page PDF files that everyone else ignores. Check the weather forecast. Adjust your sails. I'll see you in the next video.